Hey guys, Whitney here. Thanks for joining me today. I'm super excited to have everybody on. I know it's the week before the Christmas holidays, and you guys are taking your most precious resource, which is your time, and spending it here with us. I'm going to give it a little bit for people to file in the room. Also, our guest of honor has yet to join us, but don't you fear. Even things happen throughout the holiday season, but I have a treat in store for us, even if they don't show. So anyways, I would love for you to guys go over to your Q&A box and let me know when it comes to your personal finances. What is the most burning question that or obstacle that you're having an issue with? Because I want to populate that Q&A box so we have some amazing questions to ask Chris. And yay, Chris is here. Awesome.
I'm here.
Yay. Okay. Well, Chris, we have got a full house today, but let me do a quick little intro for those people who have never joined a passive investing live show. Welcome. This is a show where we study the ins and outs of passive investing as a way to build multi-generational wealth, so you can go into your next or first investment even with confidence. And so if you haven't already, check out passiveinvestingwithwhitney.com. If you want to get access to future masterclasses and see our open deals, as well as just hop on the phone with me and talk real estate. All right, so I am super excited to have Chris Miles on. Chris Miles is the founder of Money Ripples. However, Chris Miles is also responsible for where I am today. So Chris used to be my coach, still is very much a mentor of mine. I'm so excited, Chris, to bring you into the group. Chris, let's kick it off. So you and I know each other, but I want to kind of have you tell a little bit of your story, a little bit of your journey of how you got into finance and, more importantly, passive real estate. And it wasn't always that smooth of a transition.
No, definitely not. If anything, I learned really well from experience, right? I think that's sometimes the best way to learn, because you get that real life experience versus just education, book smarts and that kind of thing. And maybe like many of you, I was a person that was raised by parents or hardworking parents, taught me decent, good values. But when it came to money, that was the one thing they were not good at. Now, my dad was a great saver. I mean, he's the kind of guy that Dave Ramsey would say, I want to be like him. In fact, my dad's older than Dave Ramsey. So maybe Dave Ramsey copied my dad. I don't know. But he was like the penny pinching saver, the kind of guy that you always grew up hearing things like, we can't afford it. What do you think? What do you think? Money grows on trees. I'm not made of money. My favorite one was, I'm going to work until I'm dead. That was his belief. This is the guy that was paid off his debt early, paid off his house early. He was very proud of it. He saved everything, packed into his 401k, hoped that he would work for a company for many, many years, only to find out, of course, that companies weren't always loyal to him. Yet, despite all that, he would still pack away his money and save it. And so I grew up like that. And I said, well, I don't want to be like him. I don't want to have that scarcity mentality. I don't want to be a person that's just trying to survive. So what happened is as I went to college, I was going to become a business consultant. I thought, well, if I'm going to be a business consultant, shouldn't I have real life experience, right? And so I dropped out of college with one class to go, was supposed to be a 1-year sabbatical. And I said, all right, I got to find a business. What am I going to do? How can I get this entrepreneur type of experience? Well, lo and behold, the first thing that came up that kind of sent little bells and whistles off of my head was becoming a financial advisor. Little did I know they take anybody off the street. They can just pass a test with 70% and just not have a criminal record, right? And that's what I did. I became a financial advisor, the typical salesman in a suit. And a few years in, then the tables turned. Instead of my dad always telling me things like, hey, be cheap, save all your money, save everything you can. Pretty soon he's saying, Chris, why don't you come talk to me about my finances? Can you help me? So I remember sitting down at his table, same table that he tried to teach me all his little nuggets of wisdom about money or scarcity of money, right? And as we're sitting at the table, I look at his finances and I say, Dad, I'm going to be blunt with you because you're kind of blunt with me. If it weren't for Social Security, you better hope you die in 5 years, because you only have enough money to last you 5 years and then you're out, you're done. And he was 61 years old at the time. He had, again, saved for years, decades, yet he only had enough to just really live for 5 years. He said, well, that's not what I want to hear. And I said, and so he said, ask me, what are the other options, Chris? And I said, I don't know, because you've done everything that we would recommend. You've been saving these things. You paid off all your debt. You're essentially the poster child for what we recommend. And that bugged me. That bugged me a lot, because he was kind of the inspiration for me to become a financial advisor in the first place. I thought if I could at least give him some of his life back, that would be worth learning what I was going to learn as a financial advisor, only to realize that financial advisors are not financial experts. They're just salesmen in suits. And that was a big wake-up call for me. And even more so a wake-up call when I was speaking with a friend just a few weeks later. This friend quit being a financial advisor to go do this crazy thing called real estate investing. And so I thought I'd call him up, see how he's doing. I figured he was failing at real estate. And he said, Chris, things are amazing right now. My dad and I have partnered on some deals, and we've actually doubled my dad's income as a professor at the local university. I said, come on, you've been working together for what, 4 or 5 months? That's too good to be true. He said, I'm doing it. And we got in this little argument back and forth, really a debate, not so much an argument, but a debate about what's better, stocks or real estate. And he finally just stopped me. He said, Chris, how many of your clients are financially free, where they don't worry about money, not just retire, but they're not worrying about money? And I thought about it. I said, well, none, because even the retired physicians still worry about running out of money. Great job, Chris. Okay, how about this question, Chris? How many of you guys as financial advisors are financially free, not off the commissions you're earning, but actually doing these investments? How many of you guys can actually retire off of your own investments? None. Because I know there's guys been working here since the late 1970s and they're still not retired. There's your problem, Chris. Okay, well, what's the answer? And at first he was a little resistant, but then he started to kind of open up this world and tell me more about real estate investing and really this whole alternative world of investing that blew my mind. I knew it was kind of out there, but I didn't know just how good it was. And it's from that really now I was actually able to retire myself later that next year. I was 28 years old. I was able to become financially independent myself. As part of my story, I actually became financially independent twice, because then the recession kicked my butt and I had to dig back out of that rat race hole and come back again. But I'll tell you, the one thing I've learned is that cash flow is everything. It has nothing to do with how much you accumulate, because most people teach you to accumulate and stagnate money, but never how to get your money to flow and grow. That's a key distinction, is that cash flow mentality versus the accumulation mentality. Accumulation just helps really the financial industry make money off of you. But for you to make money, it requires you to switch that thinking around, which is why you guys are here today.
Awesome. Yeah. And most people here are very much, they understand real estate. So one of the first questions I always ask people before I work with them, on placing funds, like, do you believe in real estate? And check that box. And most people have that box checked. But I imagine, and just seeing a couple of the questions that are already in the Q&A box, it's the, I want to start filling in some of those gaps, right? Like okay, great. I believe in real estate. I know it can help me get financially free. And how do I make this crazy transition from stocks, bonds, and mutual fund world into real estate? And, Chris, in our time of working together, and I'm going to kind of pick through a series of questions. It's, how did you put it to me? It was like giving me the matrix pill, right? The little blue pill. And I remember you asked me to do some really what I considered insane things with my finances. And I'm like, you want me to do what? But it just blew open the doors and set my husband and I on this amazing course of cash flow freedom, right? Okay. So somebody's here right before a holiday break. They're sitting here as they go into the new year, and they're just like, okay, wouldn't it be amazing if next year I could replace even half my income with passive investments like real estate? How do you start? Why should they even think about that, even if they have a good job? Let's start there. Like, why is this so important to start thinking about being work optional and kind of fill in that gap first?
Yeah, I mean, it's true. But you talk about this conversation is really about becoming work optional, right? And doing the math. It really is a math game and a head game, isn't it? The math is the easy part. It's the head game that's the harder part. And of course, there's guys like Robert Kiyosaki that address a lot of the head game too. But it really does come down to that perspective of seeing what's there. One thing that's important, even before you worry about passive income, is make sure you have the cash flow. You're really addressing cash flow from both directions, because really it's all about what's your burn rate, right? How much are you actually spending per month? Are there ways we can reduce those expenses without you reducing your lifestyle? I'm not a big fan of living on rice and beans like our good old buddy Dave Ramsey says, right? I'm not a big fan of that. I believe that you can actually enjoy life, but still be a wise steward of your resources. And so first and foremost, I'm telling people, start tracking your money. Most of the time when we have clients coming in, even if they're good savers, they may not be tracking it very well to know exactly where the money's going, right? They might be, sometimes they do, but in many cases they don't. And so that's always the first step, is track your money, not just the expenses, but also the income. Really understand like what's coming in, what's going out, and are there ways we can be more efficient? Do you have those subscriptions that really you're not using anymore? Can we cut those out? I've had so many people, especially with food budgets, eating out versus cooking and all that kind of stuff. Again, like I don't say you have to cut that latte, but I mean, it depends on where your priorities are. If freedom really means a lot to you, well, great. You can cut out that latte temporarily if you want, that's fine. But it's not necessary. Taxes is another big one. Now, if you're a W-2 employee, you have less advantages for taxes unless you can become like a real estate professional. But if you're a business owner or even have a side hustle, there are so many ways to get tax breaks that most people miss out on. And we talk about that a lot. Oh, go ahead. What were you going to ask?
Well, I was going to follow up on a couple questions there. Like,
Yeah.
you said one of the number one numbers that people need to know is their burn rate. Like, how do you, if we're it doesn't seem like we're talking about budgeting here. What are we then talking about?
Budgeting I see as like a step 2, right? Many people will try to jump right to budgeting. And the reason they so often fail is because people haven't started tracking their money to see how much they're actually spending, how much they're earning. They don't really know the numbers anyway. So they just kind of arbitrarily come up with these random numbers to say, all right, my budget's going to be this. And then they end up breaking the budget because it wasn't realistic. And they say, oh, I'm a failure. Oh, well, budgets don't work. Budgets really are like a step 2. And I don't even like calling them budgets. I'd like to call it a spending plan. Because the truth is, you're going to be spending your money. You need to give every dollar a job. Even if that dollar goes to investing or to savings, you're still giving it a job, even if you're not spending it. But give every dollar a job. And the first thing you got to do is track your money. Great, easy way to do that is there's lots of tools you can use. I love using Mint, as in, double mint gum, double your pleasure, double your fun, right? Mint's a great one to use where it tracks, it's actually through Intuit, same one that does QuickBooks, same company. Tracks uses the same kind of technology, but it's a little bit more fun than QuickBooks, that's for sure. But that one, again, automatically downloads your transactions. You can start to teach it where those different categories are, where you're spending, but eventually it starts to remember it. It's kind of its own little AI, right? It remembers, oh, that particular transactions usually falls in the category of food, or that's gasoline. Sometimes it just knows if it's Chevron, okay, gasoline, obviously, right? So it kind of categorizes it for you, making it very easy. You can literally keep these things updated like a few minutes a month, maybe 5-10 minutes max. And that's per week, even if you do it weekly. I recommend doing it at least bi-weekly, at least every 2 weeks. But if you can do it weekly, even better. So start there. And then you start to look at other things too, like can we reduce money in taxes, right? Are there things we can do there? There's some great strategies, and we can go into those today or not, just depends on where we want to put the priority. Debt is also another fun one. That was one I learned firsthand during the last recession because, I ended up going from out of the rat race and financially independent to all of a sudden the real estate market crashing. And I was starting to gamble with my real estate. I was trying to bank on appreciation versus going for cash flow, which was the very thing that ironically got me out of the rat race. I started to gamble with my real estate more. And not to mention launched a brand new business that all of a sudden we were going under, almost bankrupt. We didn't quite go bankrupt, but it was close. All these perfect storm elements that came together. I was in the hole $16,000 a month. And that's when I really came to realization of, oh my goodness, I got to get cash flow under control. Even if, by the way, just so you know, even if I was debt free, I was still in the hole every month. So people was like, oh, it's because you went into debt. That's what the Dave Ramsey fans will say. It's like, no, you're an idiot. I was not going into debt, although debt became a bigger issue because obviously if you're in the hole 16,000 a month, you burn through your savings and the next place you go, credit cards or wherever you can borrow money. So when I had limited resources, that's when I learned how to find money the best. One of those places was actually debt, but looking at debt differently than how I was taught. I was always taught to hate the interest rate, right? I didn't plan to make that rhyme, but it kind of was cool. But I was taught to to really focus on the interest rate, pay off the highest one first, and then go from there. Or the other strategy was pay off your lowest balance and then roll that to the next lowest balance and keep going. But I found something that worked better. When I was really trying to figure out my situation, I was playing Cash Flow 202, Kiyosaki's game. I was playing that game, and I played 202 because you can go bankrupt more easily than you can in 101. So I was purposely trying to make it more real life. And I was hoping to find this big epiphany. And I realized that when money got tight in that game in 202, I had a choice. If I wanted more cash flow to get myself out of the rat race, I can either 1, invest it for passive income, or 2, pay off debt. Now, the truth was I wasn't always sure if there would be a passive investment coming. So I would look at the debt, and I wouldn't look at debt the same way. I wouldn't care about the interest rate. I would look at what's the rate of return on that cash flow by paying off that debt. So I called it, I started eventually, change it because I didn't want people to have to calculate rates of return off debt. So I changed it to be called a cash flow index. And so what you do is you take the balance of the loan divided by the minimum monthly payment, and it will give you a number, which is we call the cash flow index. So say, for example, you have 2 loans, both of them $10,000 balances. One's a credit card, $10,000 that you're paying $200 a month on. And it's like at 13%, let's just say, which is pretty good right now if it's 13%.
Can I have that
But
credit
then
card?
you got a car loan that's also $10,000, but you're paying $500 a month, but it's only 4%. So it's a great rate, again, a great interest rate for now, right? Well, Dave Ramsey would tell you, get rid of that credit card. If all you had was $10,000, you better pay off that credit card, cut it up, freeze it in a block of ice, do whatever you can to get rid of it. What I learned from being cash flow tight is do the opposite. I go for the one that actually gives me the most cash flow benefit today. So instead of paying off that credit card, that's $200 a month, I pay off the car loan that's $500 a month. And if you do the index, do the math, 10,000 divided by 200 on the credit card is 50. But 10,000 divided by 500 on the car loan is a 20. And that's kind of my thing, especially if it's a low interest loan, I want to get below a 20 before I actually pay it off. But think about it, if all you had was $10,000, people would say pay off the credit card. But remember, if you ever have an unexpected emergency, like an expense or a drop in income for some reason, you don't have to keep paying that $500 a month car loan. And just because you paid off that $200 a month credit card, you would be much happier and grateful if you paid off the $500 car, leaving you only with $200 obligation. You can always take the extra $500 and put it onto the credit card and pay it off in a year anyways, right? But many people don't think that way. And so I started to think in that way of paying off that lowest cash flow index first, especially if it's below a 40, go in there. And then the ones that are higher, either I refinance them to make them bigger. Same thing with mortgages, although lately, we don't have too many people refinancing mortgages unless they did some crazy thing like they set up a 10-year mortgage to pay it off. And sometimes we'll have them refinance to a 30 just to bring those payments down. And possibly if they have equity, give them more money to invest and make more cash flow to pay their mortgage payment for them, right? Things like that. And so that's the kind of thing that I do with debt is if it's a lower index, I might pay that off before investing. We actually just had a client where they had a $7,000 loan, but the payment was $420 a month. I say, guys, even before you worry about investing, just pay that off. I had another client, same thing. They had $18,000. That's all they had. I know one of the questions says, what if you don't have 50,000? Well, all they had was $18,000. And they say, we want to buy an investment property, like a cheap rental. And I said, well, that's cool. But even in a good market, you make maybe $200 a month off that. I said, well, if we take about $6,000 of this, we pay off some of these low index, they had like different credit cards, like store cards and things like that. And they had a mortgage too. I said, if we do this and we refinance your mortgage, we'll actually free up $800 a month. So here's the difference. You start saving the $800 a month, you replenish that money pretty quickly, and then you'll still have the money to buy the rental property too. But now that $200 a month added to your $800 a month you freed up is now $1,000 a month versus, yay, I made $200 a month, which barely makes a dent in my life, So that's why we want to look at both sides of the equation. We want to look at the cash flow and ways to improve it and get efficient with it. And then also, how do we take our assets and use that to create passive income, just like what you guys do with passiveinvesting.com, right? Like that's the same kind of thing you're doing is getting people to turn that money into actual passive income.
All right. So many questions rabbit holes we can dive down here, but I want to make sure that we're, tackling all the numbers that somebody needs to know to become work optional. So we touched a little bit on the burden rate. We touched a little bit on kind of how to figure out the cash flow. Or do you need to pay down debt? Do you need to save to invest? Some combination of the two. What are some other things that people need to calculate within their personal portfolio or personal finances in order to kind of paint this whole picture of work optionality?
Yeah. And so that's first, like we said, get cash flow under control, know your burn rate. Second is, what can we do with the resources you do have to create passive income? I mean, it's really that simple in my mind, at least. Maybe it's not always simple when you're in it, but it's pretty simple. So the next step is figure out what resources do you have, right? To me, net worth is worthless unless it's generating cash flow. Someone that says, I have $5 million net worth. Okay, cool. Are you out of the rat race? Not even close. I have $200 a month in cash flow coming. That sucks. Right? How do we turn that net worth into cash flow so then you could become work optional, right? So we've tried to find those places. Easy place, of course, look in savings. We look at equity, like in homes and things like that. We look for even old 401ks and IRAs. I don't mean current 401ks with your employer, although I'll add this as a bonus. Many times we'll get clients that are max funding their 401ks. Stop it. I mean, even if you're 60 and you can't access it, the thing you're going to say is, well, wait, okay, there might be one exception. Here's one exception. I'll give you this one. If you are over the age of 59 and a half, you might have an option available to you, what they refer to as in-service distributions. What that means is you can actually pull out money from your 401k while you're working at your employer, at least within certain limits. And I don't mean borrowing from the 401k. I actually discourage most people from borrowing against the 401k because the payment, if you talk about cash flow index, usually the index is about a 54. That means if you pull out the max $50,000 you borrow from your 401k, your payment's going to be usually right around $950 a month, almost $1,000 a month that you have to pay back. Do the math. That means you have to earn about a 23% cash on cash return on your investment to even pay just to break even, right? Just to break even on that payment. So I don't usually encourage people to borrow from their 401ks. But if you are 59 and a half, often you can get what's called in-service distributions from your employer. I shouldn't say often. It depends on the plan. Occasionally, you'll see that happen. If so, yes, you will pay tax on that money, but at least now you can turn around and get that money working for you now, even before you retire. That's the one exception. But for the most part, almost anybody I talk to, their 401k is like the worst investment ever, regardless of getting that match. Because who cares if somebody throws in $1 if you can never use it, right? Who cares if you get that 100% match? And by the way, I have podcasts where I've done the math on it. It only adds long-term about a 2%, if you're lucky, extra rate of return on your overall portfolio. And just so you know, 401ks have such high excessive fees compared to normal mutual funds. Even you're lucky to use the net 6% average, like actual return out of your 401k, you add 2%, you make 8%. And then of course, when you pull that money out, I mean, when you're supposed to pull that money out of retirement, financial advisors like I used to be would say you should only pull out 3% a year. It's miserable, right? So instead,
I plan on retiring on more than 3% a year, Chris.
I hope so. I had a client that he was actually on the podcast like you were. He came on because he had $1 million saved up in his retirement account with the military in California. Mm-hmm. Well, he took that $1 million, and of course, the financial advisor says, "Well, you can live on $30,000 a year before tax." He said, "Well, after I pay my taxes, I'm living on what? Maybe $2,000 a month. I'm in California. That's homeless, and I'm a millionaire technically, right?" And so that's why he came to us and we said, hey, we can get this money working for you, and actually netted him about $11,000 a month instead, just by doing alternative assets like what you guys do, doing that very same thing. That's the key, is how do we get that money out? How do we get it available so then we can turn around and use it? So if you're putting money into a 401k, say you're max funding at about $20,000 a year, stop it. Get that money instead, get that in your power and your control, and use that to start saving up to generate cash flow today versus a someday that you may or may never be able to enjoy at 59 and a half or whatever age they tell you at that time. Because if they change the laws, they say, you know what, people are living longer, we're going to make it not 59 and a half, we're going to make it 62. That just threw off your plan by 2.5 more years, right?
Well,
So
they've already started saying that they're going to raise the retirement age.
And
Like,
they keep teasing with it, and they haven't
yeah.
done it for 20 years even that I've been in the financial industry. But who's to say that that's not going to be the time that it will happen? Because right now, I mean, even the upcoming millennial generation, they're saying, I don't ever want to retire. I want to have purpose. I want to do something, right? I don't want to just sit on a front porch swinging, drinking lemonade like my grandparents did. I want to actually do something. So many of them don't want to stop working. They just want to become work optional so that they can quit. They work because they want to, not because they have to, right? And that's the same thing we're trying to do here. So again, if you have that 20,000 back in your possession that you can then invest and generate cash flow, even if it's by 100, 200 bucks a month average at a time, great. Do that, start to get that money out. So savings, old 401ks, as well as IRAs. Roth IRAs, a great place you can use. Yes, you can do self-directed, and that's an option. But again, if you want to retire before 59 and a half, you might look at options of how can you get that money out. Roth IRAs are a great thing to cash out. I'm not saying it's the perfect thing, but with Roth IRAs, whatever you've put into it, you can cash out without a penalty or taxes. So that's nice.
So let me
Any
kind of
growth
like
you have.
sound this back. So one of the things when you work with clients, you suggest like, here, where are your assets? And then what are you funding? And then, here's what you could make. Here's your opportunity cost if you stop funding your retirement accounts and instead investing them.
Yeah, we
All
do
right.
both options.
I want it because this is a perfect transition into the head game part of this, right? You said that there was numbers and then there's the head game. Okay. Because this is really where, when you looked at my finances, this is years ago, guys, and Chris said, liquidate your IRAs if you can. How can we get this money out? I'm like, you want me to do what? And he said, break up with the IRS. And I was like, no, not happening. I have worked, what did I say? I was like, I've worked 7-8 years to build up this huge nest egg within my retirement accounts. No, Chris, I'm not doing it. I was hell-bent not doing it. And then I was let go from my job. And then you showed me the math on what I needed to do. And I was like, okay, sign me up. Like, how do we do this? Oh, wait, can we have this done like in a week? But anyways, so let's talk about that head game, right? Because it is so ingrained in us on what, grow up, get a job, save for retirement, buy a house, have kids, right? Like, some different parts of that narrative in certain orders. But why is it so hard for people to really make that mental jump, that mental switch?
Well, it's brainwashing. If I were to be very blunt, I mean, it really is. I mean, I was brainwashed as a financial advisor, and you have to ask, who teaches financial advisors, right? Who are supposed to be the financial experts, And the truth is, financial institutions, companies like your Merrill Lynch's, your JP Morgan's, right? Chase, those kind of companies are the ones training financial advisors to then train you. And it even pervades through the media. Think about it. The media, I mean, if you watch Fox News, which is pretty cool, but even if you watch them, the problem is is that they still have these big financial institutions saying, hey, we're the rock, we're Prudential, invest with us, we're safe, all that kind of stuff. You're not going to hear the same news stations saying, you know what, Prudential sucks, right? Because they don't want to get rid of their $5 million contract or whatever they're paying them for that ad. So everything's kind of skewed based on money, right? You just follow the money. It's like pharmaceuticals, just follow the money, It's the same thing in the financial industry, is that everything leads back up to these financial institutions. What's their self-interest? They want you to keep money with them as long as possible. They're the ones that taught you, hey, you know what? Let it compound and grow. In fact, compounding interest is the 8th wonder of the world. Einstein said so. By the way, Einstein never said that. I found the quote. He never said compound interest is the 8th wonder of the world. You'll only find that on financial advisor pages and network marketing companies. That's it. Secondly, they will also teach you to pull out less than the interest. Why? Because they're taking out guaranteed fees out of those investments, right? So they're getting paid on the assets under management. The more you have with them, the more they get paid cash flow, right? Their cash flow is all dependent upon you leaving your money in there, accumulating money inside of there, and pulling out less than the interest. They want to instill fear of you touching it. So the problem is financial advisors and all the financial pundits, the so-called experts, have been telling you for years that you should never, ever touch that nest egg. Don't ever kill that golden goose. That is wrong. Never do it. Let it sit there forever. which of course that doesn't ever turn off even when people get to retirement, because then they say, well, I don't want to kill my golden goose, so I'll just take out little trickles and live in poverty for the rest of my life. I hope I vote in Social Security again, yay, baby boomers, we can do it, Then when Generation Xers get it there, we have like no voting power, we'll see what happens then, right? But those kind of things are what's happening. If you really just look at it with common sense, you realize we've been manipulated for decades, right? That's the thing, you have to break through that mold. And it's hard because, again, it's like everybody does it. But just because a billion people on this planet does something and it doesn't work, which, by the way, this has been proven never to work, why would we keep doing it? Just because a billion people on the planet do it doesn't make it right. Okay. I like to look at evidence. I like to see what actually works. You look at it, 25 millionaires in the United States. What do they all have in common? And I looked this up. Every time they own at least one real estate property at minimum, every one of them. You will not see millionaires that don't own properties, at least, or some kind of assets like that. But you will see that people that save in their 401ks and IRAs have a very, very difficult time trying to become millionaires with that. I looked up success stories recently. I tried to do this case study. Like if mutual funds actually work, let's put them on trial. Like, do they have witnesses? Do we have, actual evidence that it's worked? I tried to look around. The best article I could find was people that saved up $1.5 million to $2 million. And the funny thing is, most of them never did it saving in mutual funds. Most of the time it's because they got a big bonus or a pension payout from a company. Something else got involved that gave them a little extra boost to their money. I did meet a guy, though, recently where he did save about $3 million in his mutual funds, but he's also packing away between $200,000 and $300,000 a year into those mutual funds. So, of course, he had $3 million by the time he was 52. And then his financial advisor said, good, you can live on $90,000 a year. He said, I want to live on $500,000 a year, not 90. They said, oh, well, keep it up. And maybe by the time you're 65, you might be able to do that. But that's only if inflation stops. So again, all this stuff is just really rewiring it to look at it. And like with you, Whitney, like when we looked at the IRA, yeah, there's going to be penalties and taxes. So you got to factor that in, because it may not make sense to cash out an IRA. So you look at that and then say, well, what am I left with? Now, if you have a situation where, like 2020 was awesome, where they let us access 100,000 of our IRAs with no penalty. It was just taxes and you could spread it out over 3 years. That's better than retirement. In retirement, you pull it out, you still get taxed and you can't spread it out over 3 years, right? So 2020 was great, but that's not going to happen every year. So if you have a situation where you're lower income this year, then maybe you will be next year. This might be the year. It might be 2022 to access it. Now, if 2023 is going to be a better year where you might be able to write off more things, whether it's from business or maybe you're a real estate professional, awesome. Then maybe January 1st, you get that money out as soon as you can, because you don't get taxed till the next calendar year, till 2024 when tax time comes up. Great. Now I got this money I can get working for me as soon as possible. So that's the thing you have to look at is, again, what does this do for me? Because if you have $100,000 in IRA, you pull out 3%, it's $3,000 a year. Well, even if I got penalized and taxed and I lost 40% of that money to taxes, I'm left with 60,000. I invest that 60,000, make at least 10% in a passive investment. Guess what? I'm making 6,000 a year versus the 3,000 a year that I'm pulling off from the typical retirement account. So that's the thing you have to really look at is which method is going to work for you. And again, like I said, for some of you, it might just be self-directing that IRA, keeping it inside there and just finding ways to invest it inside the IRA. Sometimes that makes sense. But if someone has the opportunity where they can get that money out, especially if they're not 59 and a half and they won't be for a while, can we get you to retire earlier? Can we get you to get to that point faster by getting that money to be used to create better leverage today? And I'll tell you, I mean, even if it's 60,000 out of 100,000, that's enough. I mean, I put a $32,000 down payment on a turnkey rental 5 years ago, and it's done a 300% rate of return. If you look at all the returns of cash flow, equity building for them paying down my mortgage, appreciation, not even including tax benefits, just those three things alone, 300% in 5 years. The market didn't even get close to that in the last 5 years. So even if I lost all that money to taxes and penalties, I know that I'm way more than grateful that I made with 32,000. I've made over $100,000 with that money.
Mm-hmm. So I don't know if you remember when we were working together, my husband and I set up a little bit of an experiment, right? Because he was like, you're nuts for, pulling out your IRA, but you do you. I'm going to keep mine intact. And so we did a kind of a little like check-in on how we were, who was getting better returns on their investments. I completely lost the first year,
Yeah.
right? Like I had the tax penalties and everything like that. And by year 2.5, I broke even. And then it's been no contest since. It was just like, uncle. So it does, I guess I'll ask the question this way is, what would you say is the number one mindset shift that we can leave investors with on how to start setting themselves up for success in 2023?
Best thing to do is what you had just realized, right? That little epiphany. What's the real purpose of a retirement account? Like, let's really ask that. What's the real purpose? For most people say, well, I want to grow it so I can retire. Okay, well, how do you retire? Well, I have enough income coming in from that retirement account, right? Well, that's the ideal. I completely agree. It's what can I do with that income? What actually generates real income for me? Not theoretical, like many people do when you say, hey, in 30, 40 years, you're going to have this much money if the market averages this, but we can't guarantee anything, right? So to be able to say, I can make money today, what is that going to do? And so you really got to compare that, really look at what's the income. Like you just figured out, wait, I'm actually starting to beat anything that my husband was doing with his funds, right? I'm like far exceeding that because now that money is really taking off. It's getting better leverage. It's always about the cash flow. If you make 12% on your investment, guess what? That means you need only 25% of what the average person with a mutual fund needs to be able to do that. Because they're, again, only recommend to pull out 3% if they don't want to run out of money. When we earn 12% a year on our fund, for example, when you earn 12%, well, guess what? You're earning 4 times that amount. And we're still not killing the golden goose, right? We're not killing your equity. You still have that initial investment in many cases, or even if it's an equity play. Cool. Well, they might still have ways to pay you back principal plus interest and then still have working interest where you might be making money, even with no money invested because you got all your money back to then reinvest while you're still getting paid on that deal. Right. And then, again, all those kind of options, when you really look at that, say, wait a minute, I need a quarter of the money to do that. Just like, again, like I mentioned with Dan out in California, right? $1 million to only pull out 30,000 a year and then get taxed versus taking that same million, investing in different alternative places to then generate 11,000 a month. That's over 130,000 a year. He exceeded it by over $100,000 a year. So it always comes back to that. And that's what had to break in my mind as a financial advisor. It took a little time. It took me a good few weeks, maybe a few months to finally click and say, I'm not accumulating money anymore. My key is to actually get to the point where it's generating cash flow and income. That's ultimately what we all want. Focus there.
Awesome, Chris. I want to make sure we leave plenty of time for our after party session, open Q&A session. So where can people find more about you?
2 places are really easy. You can go to moneyripples.com. Plenty of information there, lots of education we post on that website. We also have a podcast that's on our Money Ripples YouTube channel, or you can look it up on iTunes or whatever, the Money Ripples podcast.
Awesome. Chris, thank you so much for joining us today. Don't go anywhere. And guys, thank you for spending your most valuable resource, which is your time, here with us today. If you want to get more episodes like this, join us at passiveinvestingwithwhitney.com.